Hi folks, welcome to Retiring Well. Listen, we got a great show lined up for you today. We're going to talk about health savings accounts, or what we call HSAs. The three worlds of investments. You got your safe investments, your risk investments, and then some in between. Social Security, how it's taxed. Wouldn't you like to know that? 529 plans, and then we're going to talk about load fees as it has to do with mutual funds. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory. Financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I want to talk to you about health savings accounts, or what we call HSAs. Now, normally, if you want to deduct your medical expenses, they have to be over 7.5% of your adjusted gross income. Okay, that's the first hurdle you got to get over. And then you've got to take those that are over 7.5%, put them on Schedule A, and then try to itemize your deductions. Now, that's where you can take your mortgage interest, your taxes, and charity, and that kind of stuff. So all those items have to then, if you're single, get over the standard deduction amount, which is $12,400. Now that's for 2020. Now if you're a couple, that's now $24,800. So think about it. For most people, it's awful hard for them to deduct any out-of-pocket medical expenses. So that's where these health savings accounts come in. All right. Now they're accounts that you can put money into. You get a tax deduction for it. It grows tax deferred. And then if you use it for medical costs, those out-of-pocket medical costs, they're not taxable to you. So it can be a great savings instrument if you want to save for those future medical costs. Now, an HSA has to, to qualify for it, you have to be part of a high deductible medical plan. All right, that means that, by definition for a single person, that means the deductible has to be over $1,400. Now this is for 2020, and if you're a couple, it has to be over $2,800. Now, the expenses that qualify for an HSA are very similar to the same, as a general rule, the same as the ones you take for your medical costs if you're going to try to itemize. Now, if you have an HSA, there's no required minimum distributions, unlike an IRA. Remember, by the time you reach age 72, you have to start taking them out. With an HSA, that's not the case. Now, there's some drawbacks to an HSA you want to be careful of, because if you put into them, get a deduction, and then use it for any other reason other than medical before the age of 65, you can be looking at a 20% penalty. So it's definitely an account you want to be putting money away for medical purposes. Now, another drawback to an HSA is you can pass it on to your spouse tax-free if you have any unspent monies, but beyond the spouse, if you pass it on to heirs beyond that, unfortunately, it's going to have to be taxed. Now, when you put money into an HSA in any 1 year, if you don't use the money for medical expenses, you can roll it over to the next year. So if you're healthy and you're trying to save for those future medical costs, great way to kind of start building that up. Now, you can have an employer pre-tax plan, just like any 401k and the like, where the employer could be putting away for you, or you can have an after-tax program where you do it with your own dollars, and then you can get a deduction. Now, the deduction in 2020 for a single person is you can put $3,550 into it. For a couple, $7,100. And if you're over the age of 55, you can put in an additional $1,000. So hopefully you find this valuable. If you're somebody that's interested in putting into one of these accounts, give us a call.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Hi, welcome. Listen, in this segment, I want to talk to you about what we call the three worlds of investments. I don't care what financial instrument you look at out there, they're going to fall in mainly three different categories. First of all, there's the safe category. Okay, banks have their version. It's checking, savings, maybe CDs. Okay, insurance companies have their version. They're called fixed annuities. They pretty much look like CDs, but it's with an insurance company. And then the government has their version. They're called government bonds. I mean, literally holding directly the government bond. All these investments enjoy safety because they can't go down in principal, and they pretty much give you a fixed interest rate. So we call it kind of the world of the knowns. Then you have the other side of the spectrum, which are those riskier investments, okay? These are things that can go down in value, but your interest is not guaranteed because you don't know what you're going to make. There's a lot of mutual funds that, based on what their objectives are, can go down in value, but you don't know how high they're going to go either. Insurance companies have their version. They're called variable annuities, okay? Now, variable annuities are an insurance product. They can be complex in nature, but typically they have an account value which can go down. They might have an income feature which is guaranteed, which can't go down, but you better be understanding what the difference is. But so we call that the world of the unknowns. But then there's this what we call this world that we call the hybrids, okay? It has an element of both those worlds. For example, a bank has its version. They're called equity-linked CDs, okay? Now, they're like a CD. They can't go down in value, but you don't know what your interest is going to be like a normal CD. It might be tied to some index. Let's say it's the S&P 500. So they're going to say, okay, you can't lose, but in this period of time, if the S&P 500's up, we're going to let you participate on that upside, but if it's down, none of the down. All right? So you can see it has an element of safety, but an element of risk too, because you might make nothing in that regard, but you could make a lot. You just don't know. Insurance companies have their version. It's called fixed indexed annuities. Okay? They're fixed in nature that they can't go down. But again, like a bank, an equity-linked CD, they might tie the upside to some kind of index. So again, let's say it's the S&P 500. S&P 500 from this point to this point is up. They're going to let you participate in some of that up, but again, none of the down. Listen, there's a lot of financial instruments out there. Probably pretty important for you to understand which category your investment's falling under, because if you're somebody that really wants something safe or want a hybrid, for example, and you're in the risky category, then you're going to want to make changes accordingly. So I encourage you, if you're somebody who wants to understand more your investments you have, give us a call.
Wow, Larry, what a great segment there. HSAs, health savings accounts, these things are wonderful. And I hope if you're able to have one that you have one, because there is very few things that are bad about an HSA out there. They're one of the only, if not the only account, there's no income limits. So if you find yourself a high wage earner and you could be phased out of like an IRA contribution, let's say, guess what? An HSA doesn't have those, so you can get those tax deduction if you're eligible. I personally love these things. For me and my family contribute to HSA. My wife has autoimmune disease, so we're able to use those contributions to help offset some of the expenses that come along with that. But for some of our folks out there, as an example, I met with a client recently. They had been working many years, and they were fortunate to be healthy. They had contributed, and that account was growing and growing, and there's no cap to how far this can grow. So they had a pretty sizable amount of money, and they're coming in asking, what do we do with this? How do I, how can I use this? Well, good news is you're getting to age 65, you can pay for Medicare premiums using that balance. So what a wonderful way to have a nice tax advantage account you got a tax deduction on now to basically pay future Medicare premiums if you don't use it for that, and you still can use it for deductibles and other medical qualifying expenses that come along. But boy, those things, Larry, I don't know if there's a better account out there.
Yeah, I know. And you know, Art, when I was talking about the three worlds of investments, you know, if you're somebody that has to have safety, which somebody soon to be retired or retired is, then you know it's a struggle today, folks, because you know what is money market paying? Maybe 1/10%. Even if I put money into a CD for 1 year, I'm lucky I'm getting a little better than 0.5%, right? So if I have to have safety, it's a struggle. This is where knowing about hybrids might be helpful, because this is where you can have that safety, but maybe have an element of a little bit more growth than the traditional safe investment. So anyway, folks, hopefully you find this valuable. If you're somebody that, you know, soon to be retired, and you want to kind of make sure that your investments that line up with your goals and objectives, then give us a call.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
All right, listen, in this segment, I want to talk about Social Security, but I want to talk about how your Social Security is taxed, how they calculate that. Now, IRS has a publication that it's got a worksheet that takes you through it, but basically it's as simple as this. You basically take half your Social Security and all your other taxable income, and you arrive at a number. Now they call that modified adjusted gross income, okay? Again, you take half the Social Security that you're receiving, your other taxable income, and you arrive at a number, okay? Now why is that important? Well, first of all, once I get that number, or what they call MAGI, or modified adjusted gross income, once I have that number, then they're going to look to see if I'm single or married, okay? If I'm single and that number hits $25,000, now from $25,000 up to $34,000, they're going to tax 50% of that Social Security you're receiving is going to be considered taxable income. Once you hit the $34,000 threshold, now 85 cents on the dollar of that Social Security is considered income. So two different thresholds there. Now if you're married, it's different. The first threshold, taking half your Social Security and your other taxable income, is going to be $32,000. Now they're going to look at 50% of that as being taxable income, and then when you reach $44,000, now 85 cents on the dollar is considered taxable income. Now, how does that figure in? Once I figure in how much is taxable income for Social Security, now I can take my taxable income, that Social Security amount that's taxable, and arrive at my total taxable income. And then depending on what bracket I'm in is going to determine what my tax is. Now, we don't want to forget that we also have a standard deduction we get to deduct. So let me just run you through a calculation and how this might be. Let's say that I've got $20,000 in IRA income. I've got $24,000 in Social Security taxable income. So I'm going to take half my Social Security, right, $12,000. I'm going to take my IRA income of $20,000, and I'm going to get a MAGI number of $32,000. Now, if I'm married, that's the top of that first threshold where none of my Social Security is taxable, right? Because I didn't go over it. So now I've determined that none of my Social Security is taxable income. So what do I have left? I have my IRA income of $20,000. So that goes into the pot. But now I get to deduct a standard deduction if I'm married of probably $24,000, $25,000, $26,000, which is going to totally offset all of that. So I've literally got $32,000, or let's say $44,000 of income between IRA and Social Security, and none of it is taxable. So you can see, folks, that knowing this and how my Social Security is going to be taxed is very, very important. If you're somebody that would like to know how your Social Security is going to be taxed, then I encourage you, give us a call. We'll sit down, look at your income, see what your tax liability is going to be, so you can have a great income plan.
Wow, taxation on Social Security, Larry. I don't know how much more exciting we can get here. No, but hopefully you stayed with us on that, because this is something that's amazing when you think about it. And so many times people come in a meeting with us for the first time, have either A, don't think they're ever going to pay tax on Social Security, or just don't have an understanding of how it's taxed. It is fairly complicated when you get into that. You know, Larry's done a great job of talking you through that. But think about it. You know, when you have income coming in, when you're working, there's not a lot of things you can do to control it, right? You want to make more money, and the more you make, the more it's going to be taxed, right? In retirement, when we do planning, we can kind of control that if you have different buckets of money to pick from. And when Larry talks about, you know, you take these distributions, and we joke around here when we do tax planning, call it the whammy zone. You know, you start getting into a little bit too much, now they start taxing your Social Security a little bit more. More income, they start taking a bigger chunk of it. And then after that, they're taking kind of the same amount all the time. But so it's interesting, if you're not doing planning with a tax perspective every year with your Social Security, you could be missing out. You could be leaving thousands of dollars on the table that maybe a Roth conversion would be appropriate, maybe accelerating your income, or maybe taking income from a different bucket or type of money would make sense for you.
Yeah, Art, I hate that situation where, you know, they hit the top of that threshold, and now every dollar of income they have makes a dollar of their Social Security taxable, and so it's like they're getting double taxed in a way. I love those scenarios where they come underneath the threshold and they're maybe pulling some money out of the IRA and none of it ends up being taxed. That's a great situation. Right. But you know, one of the questions we get asked all the time is when people come in, when it comes to Social Security, is, you know, when do I take it, right? And we actually have the tools to be able to, you know, show somebody how they can maximize their Social Security over their lifetime, right? And if they can tell us the day they're going to die, we can really tell them the best strategy.
That's really helpful, right? I don't think I'd want to know that, though.
No, and most people don't know when that's going to be, right? But folks, if you're somebody that, you know, wants to know when you should take your Social Security, maybe want to know a little bit about your tax planning and how that's going to look when you get to retirement, then absolutely give us a call.
Hi, my name is Jack Clunder, and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Hi, in this segment I want to talk about 529 plans. Now these are accounts that parents and grandparents can put money into, okay, with after-tax dollars. Now for the state of Michigan, I think they allow you a deduction for MESP, but it's money you can put into an account that's called a 529 plan. It grows tax deferred, and then if it's used for education, then none of it is taxable. Now, just about every state has some version of this 529 plan. I know some of the universities will have their own 529 plans too. Now, 529, you know how it gets that name? It's just the IRS tax code that created these kind of plans. Now, mutual funds, just about every mutual fund company out there will have these 529s that you could do with them also. So there's a myriad of them out there that you can participate in. And again, they're like a Roth IRA in the sense that you're putting in with after-tax dollars, they grow tax deferred, and then if they're used for the proper purpose, then it's going to be tax-free. Now, what are educational costs that it can be used for? Well, for any university, room and board, okay, the actual tuition, their books, basically any educational costs they have for that education. Now, 529 plans allow for any tuition from K to 12. Okay, so you can use it for that as well. Now, the state of Michigan has two plans. They have one called the Michigan Education Savings Plan, MESP. Now, that one looks like mostly others. You're putting money in, and it'll have, you know, some accounts that you can choose from, conservative, moderate risk, and basically you put into them, and then those funds basically manage that money going forward. And what you're hoping is that they grow to enough to be able to cover those costs when the time comes that you need them. All right. Now, they're subject to market risk, which is in college education, university costs have been rising at, you know, very dramatic rates of recent years. So, you know, the growth on these, unless they're totally aggressive in the market, is having a hard time keeping up with those college costs as they're increasing. The one I really like is called Michigan Education Trust. Now, this one is more of a prepaid tuition plan. You literally pay for the costs ahead of time. But the nice thing about them is it doesn't matter how the college costs rise, you're basically guaranteeing that education is going to be paid for. So I can pay for it today, 2 years at the university or 2 years at community college at today's rates for what it's going to cost me down the road. So I really like those. Now, for these 529 plans, you got to be careful. If the kids have them in their name, they can be, for FAFSA reasons, financial aid, 20% of it can be considered their, you know, their assets. But if you leave it in the parent's name, only 5.64% is considered assets for FAFSA. Now, grandparents can put into these 529 plans, and that's not a bad idea. Not usually good in the first couple years, but in the last couple years of their education can be very advantageous. So if you're somebody that's trying to save for college and maybe want some help trying to figure out which plan might be good for you, give us a call. We'd be glad to help. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, you know, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at sun-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Hi, welcome to Chalk Talk. Listen, in this segment, I want to talk to you about load fees in mutual funds. Now, as I show you this, I want you to understand that all load fees are different, but hopefully it'll give you kind of a feel for how these commissions are charged based on the class share you're in. Now, most mutual funds, you'll see, they'll describe the mutual fund, and then following it is like an A, a B, or C. That's the share class or the mutual fund you're in. So knowing this is very important. So out there they have what they call A shares. Okay, now A shares typically have a front load fee. And just as an example, I'll show you that they can be maybe 4 to 5% up front. That means as you put money in the mutual fund, there's a commission or a sales charge being charged right up the front that's coming off it, which is maybe 4 or 5%, for example. Then they have what they call an annual commission, or what they call a 12B1 fee. Typically on these A shares, that might be maybe, you know, 1/4%. Okay, that's just their annual commission they're going to charge on that share class. But there's usually no backload associated with it, meaning you pay the commission up front, you know, that maybe that 4 or 5%, you have your annual commission, but then forevermore you don't have any commissions other than that 12B1 fee. Now there's what they call B shares. Okay, now B shares are where you pay nothing on the front, there's no front load, okay? But the annual commission or the 12B1 fee might be, let's say, for example, 1%. Now again, that can be different, but just as an example, that's what it might be. But then there's what they call a backload, meaning depending on how long you've been in, it could be 4, 5, 3, 2, maybe 1%. Meaning once you get to a certain period of time, let's say 5 years, then there's no longer associated with it a backload. But you now have an annual commission coming off, which is still maybe 1%. Now, there's what they also call C shares. Now, where you have a C share, there's nothing up front, okay? There's nothing on the back, but there's maybe an annual commission, again, of maybe 1%. Now, some might say, why wouldn't I do a C share over a B share? Because I got no backload. Well, understand that most people that go into C shares, they're in it for just temporary reasons, okay? And so they just want to be in the account and out, and so they don't mind just a commission being charged while they're in the 1%. But they don't want to see a front load backload. Now, an account like that is going to have much more in cash because people are coming in and out of it, might not perform as well as an A or B because it's not fully invested. Now, for retirement accounts, most people want to do A because they're in it for a long period of time. They don't mind paying this up front on the deposit, but forevermore just pay 1/4%. So hopefully this kind of gives you a feel for these class shares and how they charge commissions. If you want to understand your portfolio and want to know what your share class you have, then give us a call. In that segment, I talk about how, I personally like the Michigan Education Trust Program, right? But even in our own office, folks, we have people that defer an opinion. Some like the MESP. So, all the more reason why, you want to maybe learn the pros and cons of both and make that decision for yourself.
Right. And they're both my favorite when you contribute to my kids' accounts, Larry, because you can gift to those, right?
Yeah, that's right.
So, but on seriousness out there, Grandma and Grandpa out there, if you're looking maybe to help those grandkids, what a great way to do it. Put a little money in those 529s or MESP, those trust plans, all those, any of them that maybe they've already got set up. Check with the parents and see what makes sense. And what a better gift to maybe help provide for your grandchildren's future.
Yeah, one of the questions we'll get asked a lot on these 529 plans is, well, what if I save for the child, but the child doesn't want to go to college? People have to understand that if the child doesn't go to college, they can transfer that to another immediate family member. Now, if none of them end up using it, then there is an ability to get a refund. I think they get what they paid into it plus a nominal amount of interest, but good to know. Another thing we'll get asked about these 529 plans is, can I take them out of state? What if my child is a brainchild and they're going to go to Harvard or Yale? Well, how does that work? Well, what you get in that situation is you get the equivalent of a Michigan university, all right, and then you have to cover the difference for that Ivy League college. But basically good to know, right?
Absolutely. And I think what Larry's the thing their takeaway from this too with them is talk to an advisor. Find out what's best for you and your family, because then there's other like UTMA and UGMA accounts out there that may play a role too. It's just what works best for you and your family, right?
Right. Yeah, I think and there's some cases, they can get a state tax deduction if they put into those. So that's real good to know. Art, when I was talking about those load fees, I know there's also what they call no load. Okay, you can get funds that have no sales charge. Those are typically used by managers who are managing a portfolio of mutual funds, but then they're charging a fee to manage it. So it's hard to get away from fees, folks, when you're dealing with financial instruments. But knowing what those fees are and where, very important. Absolutely. So with that, we hope you enjoyed our show. Folks, we just want to say from Centennial Wealth Advisory, Merry Christmas and Happy New Year.